Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial marketing indicators that I've been observing. So first, let's take a review. Everybody's talking about, is this the bear market bottom? We've had a drawdown in the S&P 500 of around 24% peak to trough in June. Had about a 7% rally here to start the third quarter. Let's compare bear market bottoms in the past to some current indicators that we're looking at right now. A lot of discussion about, are we in a recession or nearing one during the second half of this year? There's no doubt we're having an economic slowdown. Let's take a look at how the trade deficit is impacting GDP and dragging it down the past several quarters. And finally, real income, real personal income for Americans spiked up during the pandemic related to fiscal policy, extra direct payments. It has been declining for several quarters in a row, and it continues to decline as income remains elevated. So bear market bottoms, like I talked about on this chart, we have in the turquoise the current bear market levels for each respective indicator. In the orange, we look back historically, the average for each respective indicator during bear market bottoms. Let's take a look at where we are, a little survey, if you will, of some major data around markets. So first, PE ratio, the price to earnings. How much are investors willing to pay per dollar of future expected earnings or trailing 12 months earnings in the past? We can look at 18 versus 11.7. So valuations are elevated relative to historically where we've seen market turning points. Inflation, very similar as well. Inflation up 8.6% year over year. Percentage as of the end of May, and if you look at CPI at 3.5% historically, so inflation and valuations a little bit higher than it has historically been when market bottoms occur. Unemployment rate and spreads actually below average. So for me, the takeaway here is historically during bear market bottoms, most bear market bottoms, we typically see the labor market in more trouble. We see more risk in credit markets, and valuations are more compressed. We usually see a little more selling pressure historically relative to the actual earnings that have occurred thus far when we look back historically. Now, GDP, everybody's talking about the big R word. Are we in a recession? 2 consecutive quarters, maybe we'll reach that level during the second quarter. And if we do, a large proponent of it is going to be the trade deficit. If you look at all the major components of GDP calculations, we can see consumption, government spending, investment, housing and net exports. If we look at housing has started to slow, you can see we're at 2.7%. That's the lowest level since back in 2012 growth for housing. There's no doubt we're starting to see a little bit of a slowdown. I expect that to continue in the second quarter in terms of housing. But the big one is going to be that trade deficit. If you look at 6 straight quarters, it has subtracted from GDP growth, longest stretch since 2016. Combination of reasons. Obviously, we had the big demand, part of that driven by fiscal and monetary stimulus during the pandemic. All that savings being drawn down, excessive demand. A lot of companies went out overseas to pull in imports to increase those inventories to meet that. Also concerns during the first quarter about how the Ukraine-Russia might impact supply chains. We've obviously had supply chain issues for more than 12 months, and that's been exacerbated by the conflict in Russia, between Russia and Ukraine. And we've seen that weigh on the trade deficit, which is bringing down expectations for, or estimates rather, for the first quarter and second quarter GDP growth. The trade deficit, imports relative to exports, a big driver of GDP slowing down here during the first quarter and potentially the second quarter as well. Now, finally, U.S. real personal income. That's U.S. personal income adjusted for the inflation rate. We can see the consumer continues to make less. We've seen inflation in wages, but nowhere near, obviously, the massive amount of increases we've seen in top-level consumer price index, especially during the past several months in food and energy, those core areas that obviously hit the consumer pocketbook a little bit more than some of the discretionary items throughout the CPI and PCE calculations. If you look at those large increases in combination with a little bit slowing of income over here during the past year or so, especially relative to those big spikes up you saw during the pandemic when we saw the excessive, really, amounts of fiscal policy looking back that average or increase the average net worth of Americans during that period. And you saw the excess and spike in personal savings because of that. Most Americans spent down that personal savings, and we're seeing real personal income decline as inflation remains elevated and wage growth obviously not keeping up with that inflation month over month. So before we wrap it up, I want to thank everyone watching for a story out of Romania. A little bit of an initiative in terms of encouraging and promoting physical health and activity in Romania. We see they're offering free bus tickets for in the month of September. If you do 20 body squats before you jump on the bus, just a little promotion, a fun way to encourage activity. But I've got a better idea. If Tesla wants to step up and you can say, if anybody can do 100 body squats and 100 push-ups, you get a free Tesla. All right. I think that is the type of motivation that would really whip this country into shape. So just an idea, but I think that would work. With that, I want to thank everyone for watching, and I'll see you next time.